This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. Thank you for joining us on Money Talk. Here's the lineup for today's show. We will start with Tom Peckloff of the Ottawa Business Journal, then to Kevin O'Leary, chairman of the O'Leary Financial Group, and he'll discuss the recent news regarding BlackBerry, followed by my chat with Matt Hendricks, Senior Vice President, National Sales, Sprott Asset Management, before the news. When we come back, we will hear Ira Epstein, Senior Market Analyst at the Ira Epstein division of Lynn & Associates in Chicago. And then we'll conclude today's show with my interview with Robert Lloyd George, Chairman and CEO, Lloyd George Advisory Hong Kong Limited. But first, let's go to Tom Peckloff of the Ottawa Business Journal for an update on the Ottawa scene. It is a pleasure to welcome Tom Peckloff of the Ottawa Business Journal to Money Talk. How are you this afternoon, Tom?
I'm doing fine, John. How are you?
I'm okay, and we are getting to spring, and unfortunately for me, the skiing season is almost at an end.
Yeah, but there's lots of great stuff to do in spring.
It's a great city we live in, and let's get down to the business of the city. A key resignation this week. A collaboration between Ottawa tech firms that could be key to one's survival, and the spotlight was shining brightly on autonomous cars.
Yeah, that's right, John. Let's start with the big news out of Invest Ottawa, where their president and CEO, Bruce Lazenby, announced this week that he will resign. It may not be a surprise when you think about it. You know, he was telling me that he typically spends 5 years at a job. That's what he's done throughout his whole career. It will be 5 years in the fall. He expects to be gone by June or July. He said the time was right to pass the torch for another reason as well. Invest Ottawa is going to be the anchor tenant at the Innovation Centre at Bayview Yards when it opens in the fall. They'll also provide the programming for the facility. He said it was a good time for someone else to put their stamp on the organization in its new home. So there will be a selection committee and a search firm involved in what will be a very public campaign to find his successor. Mr. Lazenby says with all levels of government interested in infrastructure and economic development, the new CEO should have the abilities to navigate those opportunities. And as for him, he told me he's over 50. That's all he would say about his age. But he says he still has a lot of energy and he has no plans to retire. He's looking at maybe another CEO role somewhere, or possibly sitting on the board of some tech firms in town.
And which two Ottawa tech firms announced a collaboration this week?
Well, you may recall Mitel announced the 5G cloud connectivity initiative back in February. Now, the collaboration announced this week with DragonWave will be part of that. Mitel will contribute its software and mobile network expertise. DragonWave will provide all outdoor networking expertise as well as small cell focused and high capacity, spectrally efficient packet wireless backhaul solutions. The focus will be on technology and research and development at first. There will be an option to evolve commercially as business opportunities develop in the 5G market. That's big news for DragonWave. They've had a number of well-documented struggles in the last couple of years. So DragonWave CEO Peter Allen naturally very happy. He says, we're pleased to work closely with Mitel, who has both scale and common customer base. We share a focus to bring innovative solutions to the 5G mobile market. Well, the stock market certainly took notice of this. The day after the announcement, DragonWave shares were up 37% on the TSX.
That's very impressive. And does Ottawa have a future as a hub for the autonomous vehicle sector?
Well, it's certainly what Canada North BIA Executive Director Jenna Sudds would like to see. She told a networking breakfast this week she wants to see Ottawa have a test bed for autonomous cars, noting all the tech companies in the city that could contribute to the sector. The Canadian Automated Vehicle Centre for Excellence Executive Director Barry Kirk and QNX Software Systems Senior Vice President John Wall were guest speakers at this breakfast event, which was held at the Marshes Golf Club. Of course, QNX here in town, a leader in the connected car area. Now, Mr. Kirk said the city of the future includes big data, smart infrastructure, and autonomous vehicles. He's happy with the direction that the Canadian government is going. He says that he's hoping that they spend 1% of their infrastructure budget on smart infrastructure, allowing to move quickly to autonomous vehicles, data, and analytics. Now, this breakfast event was happening the very same day that GM Canada President Steve Carlisle was at Carleton meeting with students there. He said there's a staffing opportunity in front of his company. He's looking to hire greater numbers in high-end specialized areas like software and networking. He just basically was in town to convince everybody that it's a new kind of auto industry. And bringing this all full circle back to Bruce Lazenby, he was also in Toronto this week talking to GM's CEO about the autonomous vehicle industry, and he was telling me he just wants to make sure Ottawa has its share of it.
And to conclude, what's on the OBJ radar this week?
Well, we haven't talked taxis and Uber yet, but obviously it's a hot topic around town. We'll be keeping our eye on the debate in the days leading up to the council voting on staff recommendations the mayor approves of, by the way, on regulations for the industry. And these regulations would, in fact, make Uber legal here in Ottawa.
Well, thank you for taking the time to join us this afternoon, and a great update, and we'll talk again next week, same time.
Sounds good, John.
Now to Kevin O'Leary, chairman of the O'Leary Financial Group, and he gives his take on BlackBerry's ability to transition its business.
Let's take a trip to Las Vegas. Our own Kevin O'Leary joining us from Sin City this afternoon, maybe to place some bets on stories we've been following today. Good afternoon. Happy Friday. What brings you to Vegas today, Mr. O'Leary?
I am speaking to a diverse group of financial investors from around the world regarding low growth and what strategies one might do over the next 3 years. And so this is the kind of thing I love to do. It really makes me do my homework, and I'm going to have a very challenging crowd and a bunch of questions in an hour from now. Okay.
Well, we'll let them grill you, and we'll grill you in the meantime. Let's do some betting in this Vegas theme. Today, BlackBerry comes out with some results. They weren't so hot. What was your reaction? And maybe you can give us your odds on their ability to make this transition to a software company.
I'm not optimistic. I think the end game is at hand with BlackBerry now. The problem is they haven't retained 5% share of the market. And I've always felt, regardless of sector of the economy you're in, if you want to sustain a profitable platform in any industry, a good example I've always used is BMW. They have 5% of the globe's car market, but it's a very profitable company. In mobile and this kind of consumer electronics technology, and even for the enterprise, which is where BlackBerry is trying to find a home now, you have to have at least 5%. And one would think they could find a perch somewhere in a highly specialized security platform, but even that doesn't seem to be working. I think it's time to auction the assets to larger players, strategic players, to garner some value for remaining shareholders. I don't think there's another game to be played. At this point, staying independent just wastes shareholders' assets as you burn cash.
So, speaking of this handset business, that what to do about it, you're saying if you were the CEO of BlackBerry, you would consider just trying to find someone who would buy it?
I wouldn't consider it. I would do it. I would put it up for auction, hire Goldman Sachs or somebody else. This is a global asset. I don't think the government's going to get involved in this time. We've had a change in government, and since that period, a lot of value has been lost. By the way, I think the CEO there is pretty good. I think he knows this already. I think he's, cut costs and carved as much off as he can, but at some point you have to deal with reality. And this is a highly competitive market. That's clear. An element of it is consumer electronics, and that's extremely difficult, so there's no money to be made in the handsets. And all the acquisitions they've made to become a platform, a secure platform with that, hopefully has some value with a larger strategic that has the muscle to get distribution for this. And, I would think this will happen in the next 6 to 12 months. If it doesn't, the value will continue to diminish.
The mayor of Toronto, Kevin O'Leary, is heading to Silicon Valley next week to try and convince tech companies and venture capitalists to invest in southern Ontario. Let's go back into our betting mode here, and can you place a bet on his ability to get some business activity going here thanks to Silicon Valley?
Zero probability of taking one constituent out of Silicon Valley and relocating them into Ontario, and it's not his fault. We have a great mayor. He's a good salesman, and he represents us well. It's the tax environment. You've got to remember over the last 36 months, and you have to blame our premier. We've gone from a personal tax rate of around 46% for high earners that are generally found in the high-tech business, and now tax them close to 55%. That's not including all the user taxes and HST they have to live with. So you can imagine, he goes down there, he's pitching somebody at Facebook that's a Canadian and says, come back to Ontario, get paid in dollarettes, so there's a 30% discount right away, and then we're going to tax you at the highest tax jurisdiction in North America and try and build a company. It's not the corporate tax rates that are the problem. It's people are people. They pay personal tax rate. And Kathleen, our premier, Kathleen Wynne, hates small business. I don't know what else to say. She has made it so uncompetitive with all these surcharges on high net worth earners in the tech sector that we are no longer competitive. So the probability that our mayor gets anybody back, zero.
Coming up, my chat with Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, it's great to welcome Matt Hendricks to Money Talk this afternoon. How are you, Matt?
I'm great, John. How are you doing?
Good. You were in Toronto, and you've got an update for us on what is going on at Sprott, and there's been a tremendous recovery. The Fed, yet again, flip-flopped, and now it appears that they're being forced to ease and continue with lower interest rates, avoiding a couple of hikes, and that's spurred the markets on. But I wonder if you could give us a rundown, because you've got a representative list of how the Sprott funds have performed during the past month and quarter.
Well, for sure, John, but I do want to comment on your thoughts about the Fed. I mean, here we go again. It's unbelievable how central banks have just manipulated this market, and nothing is trading on fundamentals. After the worst start in the history of the markets in January, I mean, after this quarter ended, the end of March, the markets are all back in the positive territory. Huge month. The S&P 500 did over 6% for the month. Toronto TSX did 5% for the month. You know, Friday we had a good jobs number by the U.S., but the market opened up down 100 points because it's the flip-flop thinking, right? If the people are thinking the better the U.S. gets, then the stimulus gets taken away and maybe rates go up and then the market goes down. But then there's, as you say, the flip-flop, and there's no reason in the world with the numbers that Janet Yellen has got out of the U.S. now that she should be saying, well, we better hold off on the rate hike. It's a complete joke there. So once again, as portfolio managers, not only at Sprott, just across our country, it's very difficult to run money. That's why we always propose to our clients that you just have a diversified basket of funds. And I mean, our funds had a fantastic month. Energy, gold, our bond, timber. Our timber fund was up double digits. The resource sector had a really, really strong month in March. But that you have to be diversified and have downside protection because you don't know which way these bankers are going to go, and therefore you don't want to leave your portfolio exposed.
Now, could you describe flow-through strategies and what's available, because that's a very interesting tax-saving device that all investors should pay attention to.
Oh, absolutely. I really encourage listeners to listen. Flow-through shares, John, are basically your last real tax deduction in today's environment. I basically like to call it an unlimited RSP. So currently the government allows resource and mining companies to spend money on exploration and then pass that through or flow those tax savings through to the end client, which is you, the listener. So companies like Sprott, what we do is we run a flow-through fund where our manager will take our client's money and he will buy eligible flow-through shares, get a 100% deduction, and invest in the resource and mining space in the most conservative way, going with more larger cap companies. So, for example, if you make $200,000 a year, and as you know, with the new Liberal government, you're paying an extra 5% tax if you're in the highest tax bracket. Your maximum RSP deduction is, $24,000 and change. You could actually put $50,000 or $75,000 into this flow-through product and get a dollar-for-dollar deduction in 2016 and bring your income rate down. It's a great, great tax tool. Our manager, Jason Mayer, has given our clients extra returns over the years. And this year, actually, we're going with a short duration. Usually it's a 2-year hold on these LPs, but this year we're doing the short duration. So we're only holding it for 1 year. And then it flows through into a resource fund. And from there, the client can either sell or they can hold on to the fund for future growth.
Well, I'm looking at the results of the flow-through strategies from 2014 and 2015. And 2014, the returns before tax performance, the return was 30.82%, and in 2015 it was 19.48% before tax performance.
Right. I mean, flow-through's been around for a long time, and if you look from 1999, call it to 2010, these things basically made money every year. But, in the last 4 years, from 2011 to 2014, the resource sector did take a step back, and these things were underwater when they rolled over. And so they kind of lost their shine. But, we're telling clients that it should be tax planning every year, especially, again, if the broker or the end investor has an income of over $200,000 a year that they T4 every year. Buying flow-through, we believe, is a must, because you just do not want to write a check to the government. I mean, say you give the money to our manager, we give 50% back, we put that money to work, and hopefully a year later, our manager will keep you level, and then right away, you're at about a 30% after-tax gain.
And what should listeners specifically ask their advisors about with reference to the Sprott flow-through strategies?
Most every advisor out there has access to the Sprott flow-through LP 2016. So all they have to do is tell their advisor they would like to have more information on that. Or, of course, you can get a hold of me at 866-299-9906. Or always feel free to visit Sprott.com. And we have lots of information on our website about flow-through.
Now, Matt, before we conclude, let's talk a bit about Eric Nuttall's Energy Fund, which has really showed its colors during recent months. And he is a manager who has a lot of his own money in his own strategy, so he eats his own cooking.
Correct, John. So Eric Nuttall's been on our energy portfolio since 2010, and has just done a phenomenal job. And, John, he's a very high-conviction manager, and, in the third and fourth quarter of 2015, he had conviction that the oil price could not stay down as low as it was for as long as it has been, and so he was more invested than with cash. And so for the first half of January of this year, he got clobbered. But then from January 19th until the market closed yesterday, his fund has been up over 70%, 70, because of the snapback in oil and the fact that he stayed invested in these quality names that he owns. And he had conviction that he believes that there's no way that because these oil companies, 95% of them are broke at oil at these levels. And so he did 27% in March alone, and he's just doing a heck of a job running the energy fund. So I look forward to his interview that you had with him.
There's a sleeve that should be in everyone's portfolio, and obviously people should talk to their qualified registered investment advisor.
Well, for sure, John. Energy is a very, very important part of the Canadian economy, and there's no reason why you shouldn't have a sleeve of quality energy stocks in your portfolio.
That's a great update, Matt, and we'll look forward to talking again next week, same time. But before you go, could you please give us your coordinates again for listeners and advisors?
Well, John, I'm always reachable toll-free at 1-866-299-9906, and always feel free to visit Sprott.com. We have lots of quality information on our website.
Take care, Matt.
You too, John.
Stay with us, folks. After the news, we come back with Ira Epstein, Senior Market Analyst at the Ira Epstein Division of Lynn & Associates in Chicago. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
Let's stick with the theme of what's happening with the economy. South of the border, in this case, we're getting to the final half hour of trading. And in Chicago, we're joined now by Ira Epstein, Senior Market Analyst at Lynn and Associates. Good afternoon, Ira. So we are seeing a positive reaction in the market today to some encouraging data about the U.S. economy. What's been the mood from the trader perspective?
Well, from the trader perspective, you can see the Dow had a pretty broad range if you just look at it. We started off the day down. The market was fearful about the jobs data. When it came in, the fear dissipated. And as the fear dissipated, the market saw another nice rally. So the rally that won't end, that's what I like to call it, continues on right into the close on Friday.
What's the stock market relationship with what the central bank does right now? We just highlighted kind of the sentiment here for Canada's central bank. And last hour we spoke to an economist who didn't think there would be any fast moves by the U.S. Federal Reserve, because when you look closer at this jobs report data that came today, sure, there were more people getting jobs, but they aren't necessarily the jobs that are desirable long term. Maybe they're in the retail sector. Maybe it's kind of getting closer to, the spring or summer season.
Yeah, it's service sector jobs are what we're talking about. And we're not getting the manufacturing. We continue to lose in that. And then we have the problem with people coming back to the workforce, about 400,000 of them. And that is the reason the unemployment ticked up to 5%. It had nothing to do with the 215,000 jobs that were found. It's that the database became larger. So when you look at all that, I do agree. The Fed made a move. I don't think they should have made in December. I was very vocal about it here on BNN. And I don't agree that they should have made a move. I think they should have sat pat. But now that they've made a move, such as like Canada talking about what I just heard moments ago, who knows? We may even cut interest rates if we don't get what we want later. I realize people keep talking about America raising them, and I'm certainly in that camp of one more. However, if, and that's a big if, but if China, if Europe, if Britain, if we see a lot of things unfold negative as we approach the summertime, better be careful. The Fed has actually said they're looking over their shoulder at all this. So as we're doing okay and Canada's doing okay, we do look to both sides, to the left and the right. We're looking to see across these oceans what's going on, and what's going on is right now a toss in the air. The worst thing that's happening in Europe is the rising euro. No matter what they do with negative interest rates, they're going to write books on this. When I went to school, and I went all the way through a lot of economics, negative interest rates are supposed to break a currency. The exact opposite is happening. And we're not seeing that money spent on the economy internally to get things going. So I think that when we talk central banks, we have to understand they're in a learning curve. And they're learning something right now, that a different type of stimulus is probably what we're going to see in some form happen this summer, certainly in Europe.
Since we're getting big picture, here in Canada, we are laser focused on the price of oil because it is so influential to the overall stock market's move. What is your read on where the price of oil may be as we sort of head through the year?
Well, you had a jolt today when Saudi said that they will not do a freeze if Iran doesn't join in. So the only way this deal's going to happen is what I've been saying for a while. They can have all the scheduled meetings they want. That meeting will be scrubbed if they cannot get together with an agreement to possibly give Iran a 4 million barrel a day number. Even though they can't reach it, give them what they had pre-sanction, and maybe that'll make the Saudis happy. Without a deal by them, why make this meeting go ahead? You put a black eye on OPEC. You're better off with no meeting and say scheduling events, whatever it is. We'd all know what that is. In any case, the rally that we saw was a price getting maybe too cheap down to $26, carries you back slightly over the $40 mark, but now reality's back to the market. We've got Libyan's ports opening. They're going to start producing again now. We've got Iraq producing more oil. We've got Iran coming up to that 4 million barrel a day number. It's going to happen any way you go at it. Why get bullish right here? I don't get it. It doesn't make sense. So I happen to think that I'm in the camp where the low 30s are going to be challenged again, and that's where I think the market's headed right now. But what does that mean? It's still not a crunch number in the 20s at this point. And if they can get that April 17th meeting back on schedule, the psychology, not the reality, the psychology that a first move is actually taking place, that in itself could put a temporary, if not a permanent, floor under the market.
We're running out of time. Very quickly want to get your take on gold, which obviously had that nice big rally sort of at the start of the year. Now you get some data that's encouraging about the economy. What happens next?
Well, I think the gold is oversold as we're approaching the 1,200 level. I'm going to expect, and that's what I'm writing in my reports now, that the 1,200 level is where I think the pros are going to step in. I think if you close under 1180, they'll get out of it, and they'll take another fresh look at what their ideas are. And if the market holds there and starts another rally, you may go to the 1,300 level. If oil drops hard, that's off the table. Oil will pull gold down with it until you get that fear factor that the economies are in trouble again, and then the safe haven buying of gold will come back. So you have to understand where you're at in that psychological picture, because that's what gold's all about right now, the psychology of what it can do, not the reality of what it is.
Indeed. Ira, always good to get your perspectives. Have a great weekend.
Thank you.
Ira Epstein at Lynn & Associates, joining us from Chicago.
We will go to a break, and when we come back, my interview with Robert Lloyd George, Chairman and CEO, Lloyd George Advisory Hong Kong Limited. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
This afternoon, I'm joined by Robert Lloyd George, who is Chairman and Chief Investment Officer at Lloyd George Advisory in Hong Kong. Robert, welcome to Money Talk, and thank you for joining us today.
Well, thank you, John. Good afternoon. It's always a pleasure to talk.
Well, I'd like to key off your excellent investment outlook for March 2016 entitled, Has Globalization Peaked? To start, would you be kind enough to give our listeners a snapshot of your extensive investment career and your perspective on the evolution of globalization from 1979 when Margaret Thatcher gained power?
Well, John, and you and I are almost the same generation, and I started work in the City of London in 1974, and therefore we can, I think, compare what it used to be like in, if you like, the ice age of globalization before investors were able to diversify internationally, and after 1979 when, as I said, Mrs. Thatcher took the first step to allow British investors, and I think the American institutions were also moving offshore in those years after the interest equalization finished in the 70s and the ERISA legislation was introduced. So there was suddenly a wave of capital which really reached Europe and Japan first in the 70s and early 80s. And then in the 80s, when I moved to Hong Kong in the beginning of the 80s, we saw this wave of capital extend into Singapore, Hong Kong, Taiwan, Korea, and eventually into India, China, and the emerging markets in the 90s, because both China and India really changed the tack in about 91 with Deng Xiaoping's To Get Rich is Glorious and Rajiv Gandhi opening up, really as a result of very low foreign exchange reserves. So both countries needed foreign investment. They made it easier for foreign investors to come in, and they were the two big markets that we have focused on the last 20, 25 years. And we've also looked at frontier markets and all those. And I think there's a sort of limit that's been reached when you look at places like Africa, Central Asia. I mean, what is investable? Are there good legal and foreign ownership limits in place? Is there safety for investors? And are there, compelling reasons to buy companies in those areas? And I think there's been some sense of a recoil now. And does it make more sense to own multinationals listed in New York or Toronto or London? And I think there is still a case for emerging markets, but it's not growing as it used to a decade ago. There's very clearly been a change of the atmosphere now, I think.
Today, are we witnessing the beginning of the end of globalization? And what are your thoughts on the current state of the Chinese economy and marketplace?
Well, I think it would be a mistake to say that globalization is definitely ending, because, there are still enormous global trends in place, and China is at the center of those. China has multiplied its wealth by something like 10 times in the last 20 years, has become a major exporter. And the question we really have to ask ourselves, is China's export boom coming to an end? And it maybe is slowing down. And I do think that the renminbi will have to correct probably by next year, and that China will experience slower growth domestically. But having said that, here is the second largest economy in the world. There's more billionaires in Beijing than there are in New York now. There is still, when you go to Shanghai, a tremendous consumer boom going on. So we shouldn't be too gloomy. There are lots of opportunities within what is overall slower growth, more like Europe or the United States type of 3, 4, 5%, not 10% growth. So I don't think it's all bad news, but I do think we need to be cautious. Clearly, the old economy, the commodity-intensive economy, oil and mining and construction and real estate is slowing, but the consumer, internet, travel, tourism, those sectors are still going gangbusters. So, I mean, we see a divergent trend, really. And China is also exporting capital. And every day we see news of another big deal where the Chinese have bought, for example, Starwood hotels this week. They're clearly buying land and agricultural land and commodity companies all over the world and brand names. So that trend, I think, will continue for some years to come.
Robert, now it seems only natural to move on to the investment potential that you see in India in particular and the Indian subcontinent in general.
Well, you know, everyone always contrasts China and India, but they're very different animals. But having said that, India's growing at 7 to 8%. Its demographics are much more favorable than China. They're going to overtake China with 1.3, 1.4 billion. They're a young population. They haven't had any artificial controls on their birth rate. And I think that it's a free, open, and capitalist economy where there are a lot of middle-sized companies and smaller companies. I was down in Bombay and traveled around India in January. We saw a lot of internet startups. We saw a lot of companies in the consumer and entertainment and travel space, and we think this is probably the most exciting emerging market with good fundamentals. And we're looking at mid-cap companies in the sort of 2 to 5 billion market cap range. And to give you a flavor of those, I mean, I saw Z Entertainment, which is a big TV and broadcasting company, and I was fascinated to learn that they broadcast in 10 different languages around India. And it's got all these regional franchises, which are very strong in terms of advertising, and Indian young population just getting into this consumer advertising space. And then we saw some auto parts companies, some internet startup companies in recruitment and software and very similar to Facebook, Amazon, Netflix, those sort of companies starting up in India. So I think India has good fundamentals, pro-business government, strong rupee, good central bank, good earnings growth, 15 to 20%, good economic growth. And for all those reasons, I would counsel investors to take a 2 to 5 year view on India and say, this is a country where things are getting better. It's not dependent on a slowdown in U.S., Europe, or China. It has its own momentum. It's a beneficiary of lower oil prices and commodity prices generally, and it really has good, strong fundamentals. So I think we will make money there, and that would be my main bet for the next 2 years.
And I understand that you were in Australia recently and that you have some observations that will resonate with our Canadian listeners.
Well, yes, I think there are parallels between Australia and Canada. One shouldn't push them too far, but both the currencies are commodity-linked and have corrected against the U.S. dollar by some 30% odd. And clearly in Australia, they were even more, I think, dependent on the mining sector, exporting to China. And that sector has fallen by about 70% in the last 2 or 3 years, to the extent that today the real estate sector in Australia is now a bigger contributor to GNP than mining and energy. And the surprising thing to me is that actually with this fall in the Australian commodity sector, the economy is still motoring along. They haven't had a recession for some 20 or 30 years. And there are a number of areas like healthcare where I think there are some very, very good companies, and they are indeed developing products in the Australian domestic market and then taking them globally. So I saw one of our smaller companies, Nanosonics, which is a maybe $500 million market cap, and they do equipment for hospitals, desanitizing hospital equipment through ultrasound. And it's worked very well in Australia. They're now expanding in the U.S. and in the UK and Europe. And I think that the chief executive was formerly at Cochlear, which makes ear implants. And that was a company which had a fantastic track record. And so I see good stock-picking opportunities in Australia. And, of course, it has the transparency, the Anglo-Saxon accounting standards and all that, which mean that you have the exposure to Asia, but you have the good management and some comfort in knowing the people that you're investing with.
Let's conclude with your overview on markets and interest rates. Now, excluding American politics, are we getting back to normal in that old-fashioned stock picking is proving its worth over an automatic allocation to the nifty FANG shares?
Yes, John, I definitely feel that there is a swing back to stock picking and to dividend achievers, to sound balance sheets and strong consumer franchises. Having said all that, I think that the background is still uncertain. Obviously, geopolitics is one factor. The American election is another. Britain possibly pulling out of the European Union. I hope that all those things will work out better than we expect at the moment, and that we won't have protectionism, and that free trade remains the cornerstone of growth. But I worry a little bit, and this is jumping ahead to my next month's investment outlook, that we may see a surprise in the markets this year of inflation actually picking up again. And I think maybe that's a topic for our next month's discussion, because it obviously will impact interest rates and the dollar and commodity prices. So for the time being, I see a lot of opportunities in Asia, but I'm still cautious about the macroeconomic background.
Robert, thanks so much for joining us today, and we'll look forward to talking to you next month and receiving your April outlook.
John, it was a pleasure. Thank you for having me again.
Well, this past week, besides the news that the Federal Reserve Board in the United States appears to be on hold for the time being because of their concerns about the global economy, there was a local story that caught people's attention, and that is the takeover by Cara Operations for $537 million of the iconic Saint-Hubert restaurant chain that is so strong in Quebec. And both the U.S. and the Canadian market have rallied nicely during the past 6 weeks. And the oil price, of course, has climbed from a low of about $26 U.S. a barrel to the current $37 U.S. a barrel. Gold has corrected from its high around $1,280 U.S. an ounce to the current $1,230 U.S. an ounce. Interest rates in Canada will certainly be on hold, and we know from last week's budget that not only spring but stimulus is in the air, with a tripling of the projected deficit for the coming year. I'm John Budden, and I thank you for joining us this afternoon. We'll be back at 2 p.m. next Sunday. Our goal is to help you in the battle for investment survival. I want to thank Eric Green for his production of this program and express my appreciation to our affiliate BNN for all their good work. Take care and enjoy the rest of your chilly Sunday. You are listening to 580 CFRA.